Welcome everyone. We're seeing digital assets evolve very quickly from speculative trending to institutional and corporate strategies. But how can we navigate this shift in the most efficient and sustainable way across market cycles? That's what we'll explore today. Let's jump straight in. All right, Jamie. With Reserve One strategically aligning with the proposed US digital asset stockpile, do you believe we've reached a permanent cycle where sovereign and institutional demand has finally killed the traditional 4-year boom bust volatility?
I did go on record this fall and say I thought the 4-year cycle was dead. So far, the market isn't showing me that I'm correct, but I think we will see it turn around long before a typical bear market and our typical 4-year cycle would last, which would be another couple of years, honestly. I think we've got just incredible tailwinds in support of the industry, with increasing regulatory clarity coming, increasing institutional adoption, some of the big banks really stepping in a meaningful way for the first time. And I do think everything we've seen the last year will put different dynamics into the system that will prevent the traditional 4-year cycle from continuing.
Okay, thanks, Jamie. That was very insightful. Let's go to Normal. Even through the recent bear market, DDC has steadily executed on its Bitcoin accumulation strategy and is now ranked among the top 35 largest public company Bitcoin holders globally. Can you talk about the conviction behind continuing to buy when markets cool? And how the disciplined approach actually reinforces the pristine reserve thesis for your traditional food sector shareholders?
Okay, thank you. So DDC, we have adopted the Bitcoin treasury strategy as of May last year. So it's still under year one for us. But in the first 6 weeks of 2026, we have increased our Bitcoin stack by nearly 70%. Right now, we hold 1,988 Bitcoin. I think our conviction is simple, right? I think Bitcoin's 21 million hard cap makes us the strongest long duration hedge against continuing expansion in money supply and also global debt. In recent weeks, when we see this sharp pullback in price movements, it doesn't affect the Bitcoin network, and it doesn't really changes our investment thesis. In fact, we have been seeing and also taking advantage of recent pullback and continue to increase our stack. Every single purchase that we've made this year have reduced our overall costs of acquisition. And that's exactly what we're trying to do, right? We want to come out of this cycle with a much bigger stack and probably holding a Bitcoin treasury stack with the lowest cost possible, maybe after strategy, amongst our US listed peers. In terms of our narrative and our communication with our more traditional food business investors, the way to look at Bitcoin is kind of like holding, prime real estate in a scarce market, right? That they can understand. When the market dips, you don't really sell your prime real estate. And if you have the liquidity on hand, you probably want to buy more. That's exactly what we're doing right now.
I actually heard a stat yesterday that less than 10 of the Bitcoin digital asset treasury companies globally have an average cost per Bitcoin under 70K.
Yeah, hopefully we can get to within that 10. We're at 85 right now.
Thanks, Norma and Jamie. That was very clear. Let's move on to Ryan. INO focuses on academic rigor. So while Jamie and Norma are executing massive buy orders, is our underlying blockchain infrastructure actually ready to handle the settlement finality required for these trillion-dollar treasury shifts?
I think that we sort of look at this industry, I go back a while and we're moving out of the billions and into the trillions, and that's where research, formal methods, kind of what we concentrated input, output, it's all around security. And so as we continue to buy more and more and more through the public markets, as governments begin to look at stockpiling digital assets, the underlying security is something that we can't take for granted. If these things start breaking, it's going to put a lot of sell pressure on digital assets. So yeah, at input, output, I think it depends on the blockchain. It depends on what you want out of the blockchain. So there's sort of token go up, there's sort of the use case behind it, but when it starts breaking, that's not good for the industry as a whole. So the underlying research will be very important.
Thanks, Ryan. Now, Michael, from a CIO's perspective at ArgoQuant, how does the institutional smoothing Jamie mentioned changed your trading algorithms? Are you seeing a more efficient market or just one that is harder to find alpha in?
Thank you. So I'm not a DAT. We run a multi-strategy hedge fund. I actually think the market structure is quite broken at the moment. So what happened in 1010 it's really caused a lot of issues, and so we're seeing price discovery be challenged. So I think it's a great opportunity to build large positions for these firms. But more generally, I think there's a lot of soul searching going on between the industry to figure out how to execute. I think one of the key things that we focus on is counterparty risk. We've seen one firm, go into bankruptcy or halt trading in the US this week. I think we'll see more. So I guess execution and buying Bitcoin or large-scale alts is not difficult, but finding the right partners to do it, I think, is important.
That makes sense. Another one, Michael. With the Genius Act now alive, we see a push for active treasuries. Is it still defensible for institutions to just hodl in cold storage? Or is that 2026 mandate moving toward active yield generation?
So my personal opinion is I think we need to provide the DATs with, a menu of products that can help them create yield. So they should have operating businesses, operating income, as well as ability to find different types of yield on the different tokens they have. And so whether it be DeFi, CeFi, or TradFi, I think there needs to be a stack that they can choose and actively manage as treasury. So we're actually launching a fixed income business focused on Bitcoin. Our background is Bitcoin mining, and we run one of the larger family offices in the space. And so we really started that with the premise for Bitcoin miners, but I think it also applies for Bitcoin DATs. I think if you go out into the alts and the rest of it, I think the DeFi space is definitely growing up. I think Hyperliquid has got a lot of liquidity, so I'm very bullish on this year and next year for the digital asset treasuries.
All right, thank you, Michael. Jamie, as someone managing a public vehicle, does the yield versus custody trade-off Michael may mentioned keeps you up at night? How do you generate yield on your reserves without breaking your fiduciary duty?
Yeah, I mean, Michael touched on it. It's very much about counterparty and counterparty risk and making sure you're doing a really deep dive on who you're trusting with your yield programs if you're using a partner for that, and that's true for custody as well. You want to make sure that they're appropriately regulated. You want to make sure that if insurance products or hedging products need to be applied, that you're doing that, and you really have to make sure that you are executing on your fiduciary duty, and ensuring that you're not getting into a situation like we saw in the blow off of the last bull market, where people were generating yields without understanding where the yields were coming from. They didn't understand their exposure to super high risk trading, and that led to mass contagion across the industry, which luckily we're not seeing that happening right now. Although the bankruptcy that Michael mentioned did happen this week, we think there are a few more still to come, but not at the level that we saw in the last cycle, and certainly not with the same sweeping contagion that we saw last time.
Gotcha. Okay, so Norma. DDC recently onboarded with a number of institutional grade custodians and execution partners. As the company scales its treasury operations, what institutional infrastructure and risk management frameworks have you built to ensure execution quality and maintain shareholder confidence?
Yeah, I mean, when we launched the strategy in May, we took a few months before we start really actively stacking, just to make sure that we have the right infrastructure in place, and that goes from execution process, having the right custodian partnerships, and building internal control and having the right governance in place at the board level to monitor overall the execution of our strategy, just to make sure before we start running we have the right groundwork in place. And once we have done that towards the end of July, we really started actively accumulating. So I think that's the first step. But I think when I look at building investor confidence or building a strong following for DDC as a stock in general, it also goes into building that community and also communication with that community. And so we have been very transparent in terms of key metrics in this space, including Bitcoin per share, with every single purchase we've made so far. And if you go onto treasury.ddc.xyz, you can also see a very comprehensive dashboard on every metrics you would like to know when you are interested in investing or building a position into DDC. So I think having the right infrastructure in place and also having a good communication and transparency with investors are two probably key ingredients in building that track record and confidence with the investment community.
That's clear. Appreciate that, Norma. So, Ryan, we're hearing a lot at this conference about moving from asset-centric to capital-centric models. Does input and output see a need for a universal standard that allows Jamie's reserves and Norma's treasury to be interoperable across different chains?
Yeah, I think in terms of the technology, that's interoperability is just a place we have to get to. Blockchains working together, asset technology working together is going to make the industry rise as a whole. Right now, I think we do have a bit of disconnection between them. Blockchains have kind of operated in a way for years where they're all trying to win the game themselves. I think what we've seen over the last couple of years, though, is much more partnership. There's not going to be a single blockchain that wins. I sort of look at each of the, tens of thousands of blockchains now as they're more like different icons on your computer. It's not that one of them is going to dominate all of it. It's not going to be the computer. So I think, the next phase of blockchain is, getting the consumer involved, blockchains partnering with each other, utilizing what they're good at in that partnership and producing better products.
That is a very idealistic perspective that I hope comes true.
All right. Norma, DDC is uniquely positioned as an Asia-based Bitcoin treasury company listed on the NYSE. What advantage does being based in Asia provide to DDC that its Western listed peers may not currently enjoy?
I think that's a great point. For those of you who don't really know DDC yet, I founded this business 13 years ago based out of Hong Kong. So it's great to be back in my hometown where I founded this business a long time ago. It's great to be part of this event. I think we are in a really great position, right? And I feel blessed and grateful that we have a strong operating business, growing and profitable here in Asia. But at the same time, we're listed in one of the best capital markets, best exchange in the world. We get to enjoy the liquidity, the access to investors like no other markets. And because we have been operating in Hong Kong and across Asian markets for more than 10 years, we do have a good footing and a sizable investor network already. And I think those relationship eventually translates to different access to capital. And if you look at that model, right, what is one of the key ingredients to success is really having access and having a broad variety of access to capital that I think right now we currently enjoy, especially during down cycle. Because during down cycle, the more traditionally available channels, such as issuing common equity, might be shut down, right, to other peers. And during these times, we can tap into different pockets of capital to continue to grow the stack as we want.
Yeah, I can see that Asia, especially Hong Kong, is now is the best place to capture the opportunity. Yeah. All right, Ryan. INO works with government level infrastructure. How does a private firm like DDC or Reserve One compete for liquidity when nation states start building their own national digital asset stockpiles?
Well, I hope that they're not going to be fighting for liquidity. That's going to be the other side of the trade, which means they're hitting the sell button. I really think it's going to go the other way. When governments really start to get involved, they kind of make these announcements, we're going to buy digital assets, but they haven't really gotten started with that yet. And in the digital asset treasury space, like the focus is clear. It's raise money, buy asset, hold asset, asset go up. When the government starts getting involved with that, kind of doing their own digital asset treasury, I think that lifts the industry, puts more money in the system, allows counterparties to become larger, and that actually when skies turn gray, it starts raining like it did last week, there will be more liquidity in the system, and that will just cause less volatility. In terms of the cycles that we see in blockchain, it feels very bad when we have these downturns that happen fast, but if you look at the charts, they're not as severe as they used to be. And I think that's because there is more money in the system. And so government starting to buy is just going to help alleviate that problem.
That's a good point. All right. Michael, does the US Genius Act actually provide the cash lag plumbing you need for ArgoQuant? Or is the industry still struggling with the friction of fiat to crypto flows?
I think there is still some friction there. So if you look at the mechanism with which you trade, so if you have underlying collateral and tokens, you have to go out and borrow stablecoins, and you can monitor the rates of that borrow. They're still quite high. So that means there's a hurdle rate to actually make returns. And so I think what we'll see both with the Genius Act and Clarity Act is the, institutional acceptance of, the higher liquid altcoins, the top coins. And when that happens, I believe the, the hurdle rate will come down, so the cost of your borrow will come down. But at the moment, it's still quite difficult to put some of this collateral to work. The exception there is Bitcoin and ETH. The rates there have come down substantially. They've basically halved in the last 12 months. But we expect them to half again. And again, this is really, I think, due to the US administration doing a 180 and accepting digital assets. So I think globally, that's also, you're seeing that happen. It just takes some time.
Okay, that explained a lot. Jamie, you've used the SBAC model to scale. In the current 2026 regulatory environment, is the publicly traded holding company still the best vehicle for digital asset exposure, if you think?
I think it's not one size fits all. It really depends what kind of exposure the investor's looking for. If you think about the version 1.0 of DATS was really the publicly traded Bitcoin miners. I used to be the CEO of HUD 8. And we started hodling our Bitcoin in early 21, and most of the other Bitcoin miners did as well. MicroStrategy still had its software business embedded. But investors were coming to us as publicly traded Bitcoin miners and MicroStrategy because they wanted exposure to Bitcoin, but they wanted it in their traditional financial vehicle. They wanted it as an equity. They wanted to use their financial advisor that they'd always been using, or they wanted to put it in their 401k or their RSP or whatever. And so I really think this is an evolution of offering investors something that they've been looking for a long time in an equity.
Okay, I think, yeah, also that's a huge opportunity for everyone. Michael, we're seeing agentic finance dominate trading desk. How much of today's market cycle is being driven by AI agents? And does that make Jamie's job of predicting the market impossible?
So I don't think there's a huge amount of AI agents right now. I think there's a lot of talk about it. I think it's a little bit of, I guess, overemphasis, as it were, in terms of actually what's happening behind the scenes. So I think Jamie's job is very much secure for a long time. I do think that we end up having a lot of co-pilot, and we already have that at our firm. And so I think it's actually a tool that will help us all become more efficient and be able to make better decisions.
I don't think our job is to predict. I think our job is to have a business model that has embedded optionality to allow you to be fluid in market cycles.
Well, I'm glad to hear that. Okay, Ryan. If Michael's AI agents are moving at sub-millisecond speeds, does INO's focus on former verification and academic safety become a competitive disadvantage in an execution-first market?
Yeah, kind of the explosion of AI and AI enablement and blockchain. I think we're just getting started there, right? But it's moving so quickly that blockchain and AI, they just kind of go together. They just kind of rhyme. So I've sort of seen this where you have these, AI agents going out, making trades, picking up token, bringing it back, talking to each other. It's wild, and I think we're going to have a massive problem, or there's going to be a lot of tipping of strategy going on, even by the agents coming up here. So I think you have KYC, KYB. We're going to have KYA. You got to know your agent. You're going to have to verify what that agent is and who's behind it. And that verification is going to be very important so you know who you're dealing with. On the other side of the table, knowing who they are and validating them, privacy is going to be a huge element of what comes next. Blockchain, phenomenal. 1.0 in terms of transparent, immutable, right? That's great for kind of when you don't know who you're dealing with, But what about when you want to trade and do business with your counterparts, move money or data from one place to the other? Privacy is going to enable strategy, and that's going to enable bigger institutions who have 40 different counterparties be able to just deal with one, not tip trades, not tip data, not tip movement. And so I really think, privacy's been kind of hot in 2025. I think that just gets bigger because that enables the whole other side of the market that blockchain isn't today.
Thank you. Well, we're definitely in the middle of AGI, so I'll wait for the KYA season. Yeah, thank you. All right, next, Jamie. Reserve One has a 20% altcoin allocation. In a deleveraging event, these often correlate to 1.0 with BTC. Does this diversification actually provide performance, or is it just added noise?
Well, we didn't see alts perform the way they normally perform relative to BTC last year at all. So I think, the historical way we think about correlations, we need to revisit that. We're the only diversified digital asset treasury company that's publicly traded or about to be publicly traded, as far as I know. And the intention was really inspired by what we were seeing from the federal government in the United States. So about 80% of our allocation will be to Bitcoin, and then the balance of the alt sleeve being inspired by what the Fed has said they intend to maintain in the digital asset stockpile. But then weighted based on free float market cap and their ability to generate yield. And I think that's one of the key differences. The alts, you can generate more yield more easily, more securely from Ethereum and Solana than you can from BTC today. I do think that will change, but our business model has always been to generate yield. We don't have a passive strategy, and so I think the diversification, the yield generation, it allows really, as I kind of alluded to earlier, I think investors can get exposure to the broader ecosystem as opposed to just a single asset or a single token, but again in a traditional financial vehicle as an equity.
That was clear. Thanks, Jamie. Norma, DDC has a unique asset that pure play Bitcoin treasury companies don't. A real consumer base from your food business. Like, are you thinking of ways to integrate Bitcoin and blockchain into the core business to improve performance?
Yeah, I mean, when I first started thinking about adopting the Bitcoin treasury strategy towards the end of 2024, really thinking about how to integrate, Bitcoin and blockchain with the underlying business has been top of mind since then. And right now, I think we've identified, a couple opportunities in the near term that are, practical and executable. And I do believe, as the DAT model continues to evolve, over time, we're going to see more possibilities of how to integrate or how having a growing Bitcoin stack can make your underlying business much more efficient and profitable. And right now, two things are, we are exploring Bitcoin-backed loyalty program that can hopefully, engage with our consumer better, drive down, marketing costs. That's one thing we're exploring right now. But, most of our consumers, millions of them are in mainland China, and given the government stance on Bitcoin, we have to think about how to work around that. Second thing, which, we think is really exciting, is as we continue to add to our Bitcoin treasury and as the market return, hopefully, our share price and the market cap of the company continue to expand. It makes us that gives us a lot of leverage and opportunity from an M&A perspective. Growing through acquisition has been part of our strategy for the underlying business since before we listed in 2023. As our stock becomes more liquid and becomes more valuable, it makes us that much more effective when it comes to acquisition. That means we're building a virtuous cycle where our stock becomes more valuable. We can buy companies that are profitable and cash flow generating at a very effective cost basis, and that adds to our ability to use our own cash flow to stack more Bitcoin, and so it becomes a very positive flywheel effect, if you will.
Thanks for sharing that. All right. So this question is for the whole panel. If we see a black swan event tomorrow, what is the one execution risk that could derail the institutional era? Is it technical, regulatory, or a lack of human talent? Jamie, you can start.
Well, the thing about black swan events is they're really hard to predict, or they wouldn't be black swan events. I think it's unlikely that it would be regulatory, although when China banned Bitcoin mining, when I was in the mining space a few years ago, that was certainly a big event that ended up being really, really positive for the Bitcoin miners in the space. I think it's probably technical. I think 1010 was a good example of a black swan event that we didn't see coming. We didn't fully understand the risks involved. So my guess is it's something like that.
No, I agree with Jamie. I think it's probably something like a breach amongst one of the big institutional custodian that could lead to potential real losses for customers, institutional customers that can derail the adoption rate.
Yeah, I guess I think we have a lot of black swans. Almost becomes a normal in this space, but every time we have one, we become much more robust. And I think, as businesses, we're used to this volatility, and so I think as a crypto industry and different parts of it, you have to almost become armored, if you will, and expect this type of vol. And I think that sets us up for success.
Yeah, definitely technical. It's not a human talent problem. Regulatory seems to be going in the right way, although that can feel that can feel very badly. We just came out of a previous era where it's very difficult to do business in blockchain, kind of get anything done. But yeah, it'll be the underlying security. It'll be, does it break? Can you use it? Can it be reliable? What are you building on top of? Because there's going to continue to be stack on top of stack until you get to much more consumer use case. So if it breaks down, that's going to be the event.
It's nice that no one said fraud.
All right. Now I have questions about the future. Ryan, by 2027, will we still be talking about digital assets? Or will the performance mandate have simply absorbed blockchain into the standard global financial plumbing?
Well, I think we're headed that way. You kind of look at 2025 and the digital asset treasury it's a really cool new product. I mean, it's access in the public markets. It can go on balance sheets where, just crypto can't. I think the day that we actually stop talking about blockchain as this is a blockchain project and we start talking about, well, this thing's just better and blockchain's enabled in it, that's when, we're sort of reaching a place where it's just technology. We're making people's lives better. We're coming up with new products. In the public market space, I think the digital asset treasuries are just the beginning. There's all kinds of technology companies in the public markets all over the world. It kind of took the digital asset treasury to kind of get that started. It's a bit more simplistic. It can be beta for exposure to underlying crypto, but I see this becoming bigger. You can utilize public markets to build out a treasury inside a growth stage company that's a blockchain development company, pulling down subsidiaries, cash flow positive businesses. So I'm very thankful for 2025 and kind of the explosion of the digital asset treasuries because it's just the beginning and sort of setting the scene of how blockchain, I think, enters the public markets, and blockchain does things a little differently, and this is just one way in which I think we're starting to get out there and explore what can we do in the NYSE and the NASDAQ.
Great. Norma and Jamie on the endgame question for both of you. Is there an exit strategy, or is the 2026 mandate a permanent reserve where you never sell, only borrow against the asset?
Do you get the end game question a lot, Jamie? I get that a lot.
No, I actually don't. So look, a digital asset treasury is set up. It has the ability to be a permanent capital vehicle. It really depends how each company is structured. Again, not all DATs are created equal. I would say none of them are exactly equal. In our case, we have the ability to allocate into investment opportunities that we like in the space, liquid, illiquid, early stage, late stage. And so in those circumstances, it would mean diversifying out of the digital assets that we hold on our balance sheet to invest in something in the ecosystem. But not every DAT is set up with the ability to do that.
Yeah, I totally agree. I think every DAT is unique. And as I mentioned before, I think for DDC, we're in year one. So I'm definitely not thinking about the end game at the moment. We're just starting. And, for me, it's just staying focused, heads down, and continue to build the stack.
Yeah, agreed. Thanks, Norma and Jamie. Michael, as a CIO, what is the one metric besides price that will prove to the world in 2027 that executing digital asset strategies was a success?
So I think it all comes down to liquidity. So we have a lot of competing thematics currently going on. We have a lot of mega IPOs coming to market this year, next year. Tokenization is a new thematic that's going to play out. I think blockchain and alts can support all this, but liquidity is king. So price discovery is based on that, and without liquidity, you can't get in and out. And so for our business especially, we have about 40 different managers that we allocate to and a huge internal team. Liquidity is our oxygen.
Thank you for sharing that. All right. If we're time to close, so if there is one takeaway from today, it's that the crypto cycle has evolved into a capital cycle. Whether it's Michael's AI-driven execution, Ryan's research-heavy infrastructure, or the board treasury visions of Jamie and Norma, 2026 is the year where hodling transitioned into active engineering. As we look toward 2027, the mandate is very clear. Those who treat digital assets as a speculative bet will be replaced by those who treat them as the fundamental infrastructure of the global economy. Thank you to our panel for showing us what performance really looks like.
Thank you. Thank you, Laura.
Thank you.
Thank you.
Thank you, everybody.